Hello everyone, I am Erica Anapisa, and today I will be discussing sample problems under Chapter 17, Financial Planning. The first problem is Austin Grocers recently reported the following 2015 income statement in million dollars. For the coming year, the company is forecasting a 25% increase in sales, and it expects that its year-end operation cost, including depreciation, will equal to 70% of sales. Austin's tax rate, interest expense, and dividend payout ratio are all expected to remain constant. The first question is, what is Austin's projected 2016 net income? Showing you here the 2015 income statement. So increase in sales for 25% will give us 875. Operating cost, including depreciation, is 70% of 875, which will be 612.50. The interest and taxes will remain the same, which will give us net income of 133.50. To solve for the dividends, we must first determine the payout ratio that can be derived from the 2015 income statement. Payout ratio will be dividends over net income, which will give us 33.33%. So net income times the payout ratio will give us dividends of 44.50. Deducting the dividends in the net income will give us addition to retained earnings of 89. So the second question is, what is the expected growth rate in Austin's dividends? So the dividends from 2015 is 32 and the dividends for 2016 is 44.50. So to determine the growth rate, we must deduct the dividends 2015 from the dividends of 2016 divided by the dividends of 2015. This will give us the growth rate of 39.06. For problem number 2 is, what level of sales could Walter Industries have obtained if it had been operating at full capacity? These are the given from the problem. Sales 5 billion, fixed assets 1.7 billion and capacity 90%. So to solve this, we will use this equation. Using the equation, the full capacity sales is equals to 5 billion of the actual sales divided by the capacity, which is 90%. Full capacity sales is 5,555,555,556. The second question is, what is Walter's targeted fixed assets over sales ratio? So these are the given from the problem. To solve this, we will use this equation. So the targeted fixed assets over sales ratio is equals to 1.7 billion divided by the sales at full capacity, which will give us 30.60 ratio. The third question is, if Walter's sales increase 12%, how large of an increase in fixed assets will the company need to meet its targeted fixed assets over sales ratio? These are the given from the problem. To solve the problem, we will use this equation. Sales with 12% increase will be 5.6 billion. So the required level of fixed asset will be 30.6% times 5.6 billion will give us 1,713,600,000. To determine the increase in fixed assets, we need to deduct the earlier estimates of fixed assets to the required level of fixed assets. This will give us 13,600,000. Let's proceed to the problem 3. Pierce Furnishings generated 2 million in sales during 2015, and its year-end total assets were 1.5 million. Also, at year-end 2015, current liabilities were 500,000, consisting of 200,000 of notes payable, 200,000 of accounts payable, and 100,000 of accrued liabilities. Looking ahead to 2016, the company estimates that its assets must increase by 0.75 for every 1 increase in sales. Pierce's profit margin is 5% and its retention ratio is 40%. How large of a sales increase can the company achieve without having to raise the fund externally? So these are the given from the problem. To solve the problem, we will use this equation. So using the equation, we will now have the sales in 2016, which is 2,068,965.52. Also note that the liabilities will only include the accounts payable and accruals, which increases spontaneously with the sales. So to get the increase in sales, we must deduct the sales in 2015 to the sales in 2016, which will give us 68,965.52. So sales can increase by 68,965.52 without additional funds being needed.